Brad Williams, Frugal Finance, hedging translation exposure. Many corporations in international business have subsidiaries that earn revenue in foreign currencies and remit their profits to a U.S. parent company. The U.S. parent reports its income in dollars, so the parent's reported earnings fluctuate with the exchange rate between the dollar and the currency of the foreign country in which the subsidiary operates. You may be doing this. You may be the finance/accounting person that is reviewing these currency variations, translating or determining the exchange difference between the subsidiary and the parent company. That's another job. This necessity to restate foreign currency earnings in the domestic currency is translation exposure. For many firms, Apple, for example, Coca-Cola, for example, for many firms, fluctuating earnings are an anathema. To avoid variability in earnings stemming from exchange rate fluctuations, firms can hedge with foreign exchange futures. Table 820 shows euro exchange rates for January-December 15th. Faced with these exchange rates is Copper Trading Company, a subsidiary of an American firm. Copper Trading expects to earn euro 12.8 million this year and plans to remit those funds to its American parent. With the December futures trading at $1.2533 per euro on January 2nd, the expected dollar value of those earnings is $16,042,240. If the euro falls, the actual dollar contribution to the earnings of the parent will be lower. The firm can either hedge or leave unhedged the value of the earnings in euros, as Table 821 shows. With the rates in Table 8.20, the 12.8 million will be worth only 15,302 on December 15th. The shortfall could have been avoided by selling the expected earnings in euros in the futures market in January at the December futures price of 125.33. Table 821 shows this possibility. With a contract size of euro 125,000, the firm could have sold 103 contracts at the January 2 price. This strategy would have generated a futures profit of 744,175. 103 contracts times 125,000 times 0.578 per euro. The futures profit would have almost exactly offset the loss in the value of the euro. And Copper Trading could successfully make it its needed contribution to the American parent by remitting 16,04675. Hedge or no hedge? There's a lot of discussion as to should corporations hedge. Here's the deal. That argument has a lot of merit because publicly traded companies are at the mercy of their investors. When you have a State Street or a Jane Company or BlackRock or what have you, that owns a sizable chunk of your company, who's better at hedging? They're well diversified. They have the capability of diversification. Should a company hedge? I don't have the answer to that because you're going to see across the board where a lot of companies will partially hedge, fully hedge, or not hedge at all. Look at airlines. How many hedge? And I know this is a little bit off track because we're talking about exchange rates, but we're mentioning futures here. How many airlines in the long term have hedged fuel prices? Southwest is the only one that has long-term successfully hedged. The other ones do it part-time, and they're always wrong. They short when they should have longed, and they long when they short. It's an internal question that a lot of people ponder. Is the cost worth hedging? Here's an overview of what I just discussed. I'm going to let you go through it. It's self-explanatory. Keep in mind, in this particular case, when one of the two exchanges goes up, the reason you hedge is because the other one is probably going down. You may take a loss in one, but that's offset against the gain on the other. And we'll get into more examples, but that is a brief explanation of translation exposure. Brad Williams, Frugal Finance. See you soon.